Welcome back to another of the Austin series of Down the Middle. I'm sure you know who this is. This is my third interview with Chris Cole. He's the founder of Artemis Capital. He's been kind and gracious enough to let us use his amazing space in downtown Austin to film this week. Thank you very much. It's good to see you again.
It's great to see you too, in person.
In person again. I know, we're in person again. I'm a Bloomberg headline. I was joking. Well, I put it out on my private Twitter feed that I've just launched because it's private, so not everybody can come and troll me. But I said I'm a Bloomberg headline. I'm triple Pfizer vaxxed. Yeah. So that was a Bloomberg headline a few days ago. Anyways, but it's great to see you.
That was a headline.
It was a headline. I'm a Bloomberg headline. This is pretty cool.
Okay. Yeah.
So you've just emerged from a cave. So last time we met, you talked about 10 days of meditation. So let me tell you, you've inspired a lot of people to push further and harder when they're doing their yoga, because they're like, okay, if he can do it for 10 days, I can do it for 10 minutes. So thank you for that. But now you've just emerged from a cave. Why were you in a cave, and who are you with?
Well, I think 10 days of meditation, I mean, boy, there's people doing 30 and year round. So, maybe everything's in
it's all relative.
It's all relative. Yeah,
okay.
Exactly. But yeah, so we went out, me and my coding team, and there were actually two caves. One was a personal one and one was a professional one. We rented a ranch out in Driftwood, and we just had a hackathon for a good week or so, and just drilled in coding nonstop. And it was.
Can you explain what coding is?
In
your world?
Computer programming in Python, just round the clock together.
Python, my gosh, I haven't heard Python in some time.
So it was me and my quant team and my puppy. So we were all hanging out.
You have a puppy?
I have a puppy. Yeah.
What kind of a puppy?
He's a rescue. So he's
awesome.
So he's kind of a half terrier, half German Shepherd. So
cool. You'll have to send me a picture. Well, did you make any discoveries?
Yeah, we got a ton done. It was fascinating. So it's amazing sometimes when you just do concentrated period of work. And I know you've had this experience with writing as well.
Yeah.
And writing is no different.
I literally call it I have to rip myself off Twitter on Wednesdays. I'm like, I've got to go back to my writing cave. Yes. And that's what I call it. I've got to go back to my writing cave.
Yeah, the writing cave. And it's just like we just had a coding cave. And I think, coding like writing, and I do some writing too, but it's I think it just requires intense focus. So we just tried to eliminate all distractions, had a chef come on in, and we're just round the clock. And these guys, my quant team were saying it was almost like going back to grad school in some ways.
Yeah.
Finals.
Well, that's what it would. Yeah. That's what it would feel like. I mean, in fact, I was. My kids asked me recently. They're like, "Mom, have you ever stayed up all night?" And I said, "Well, yes." We were just talking before we started filming about Jeff Sandifer's entrepreneurship class in my MBA program. It was the hardest thing I'd ever done, and.
Yeah.
You get 48 hours with a team of 2 other people to come up with an entire business plan for a company, all the way from marketing to financials. So I stayed up for 2 nights in a row. I was like, I've actually stayed up for 48 hours before when I did that in business school. And they're like, well, that doesn't sound like very much fun. Did you party all night long at some point? And I'm like, it was not a party.
No, it was not.
Not a party. I learned a lot, but it was not a party.
Yeah, and that level of concentrated focus, I think that's when, at least for me, is when the flow state hits, and when you can actually get some really good progress done on things. So I was actually, as much as I love interviews, I was a little worried about this one because I'm kind of like, in some ways when you're sitting there coding or writing, it's almost a different view, right? It's a different mindset,
language.
Different language.
I mean, you have to. I mean, you had to translate yourself back into the English-speaking world.
Yeah, it's like, do I know how to talk anymore? Hopefully, I do. So we'll see.
You're doing well so far.
Okay so far, yeah. But and then also I spent a little bit of time. I always do over the Thanksgiving period of time. I always do a period of time of just self-introspection and reflection. So I did that this time in Sedona, which is a great spot for me.
Oh gosh.
A lot of journaling, a lot of thinking, a little holotropic breath work, and
cool.
Whatever it is. So.
Okay, so I want to touch on something that we've never really spoken about before.
Sure.
And the last few down the middles that I've done with Mike Green, Simplify, with Vincent Deloild, I love to say his last name, la la la. They both live out in Marin, California. They're practically neighbors, and they have a hiking group with Brent Johnson, and it's really kind of cool. But I've learned so much from the two of them about target date funds, in 401ks and the power of passive investing and how it is a mechanism that's feeding on itself.
Yes.
It's literally, it's like your snake.
Yes. Yeah.
It's eating the market whole.
Yeah.
And it's accelerating.
Yeah. A snake devouring itself. That's right. And
what do you call that again? Remind me.
Ouroboros.
And that was your second paper?
No, I mean, that was actually, it might have been my fourth, yeah, because
Okay.
it's been almost a decade of writing now. But the 2017
17, that was for me at least, that was my introduction to you. That's if I'm looking in the camera right now, if you've never read the piece, go back and Google it right now and just read it. Trust me. Thank me later.
Like Volatility and the Alchemy of Risk is that piece. Yeah, with the big snake
Yes.
devouring itself, the snake made of money. But yeah, the idea of passive, and actually, Mike, it was a great honor of mine several years ago, where Mike, even before he came out with this theory of passive, called me up and asked me to test it. He was kind of, he was vetting some of his ideas. And so what's fascinating about that is that he asked me to develop my own independent model to test this idea about this tipping point where passive becomes a systemic risk.
Right.
And so I developed my own model, and what was shocking is that we came up with almost the exact same number. Mine was
Okay,
actually.
I just got goosebumps, which makes me a real dork. Anyways, keep going.
It was the concept of at what point is passive investing, does it become so dominant that it destabilizes the market? And his number was slightly lower than mine, but he had a different assumption. We actually figured out what that was, and his number I think was closer to maybe 37%. My number was around 44%. But long story short, you can make some adjustments in the model. But effectively, this concept, and there were two aspects to his theory on that, which was the first is this idea that, which I immediately bought into, was the idea that passive investing amplifies volatility. And that makes sense, right? So the analogy that I used to like to give a lot was that if you're someone who's incredibly drunk, or excuse me, if you have a really drunk client that is out of control and they drink too much, your job is to get them home safely. Well, the problem is that the more they drink, the more they stumble around out of control, and so the more passive investing is, the more the market moves in any one direction. There's no incremental buyer or seller. So in many ways, that becomes a volatility amplifier. But the second aspect to his theory was this idea that passive investing actually reduces alpha for active management. I didn't initially buy that, but then I bought into it later on after doing my own testing. So the idea behind that is this idea that as more passive actors come into play, there is less opportunity available for active management.
Right.
So if we go back to the individual helping the drunk person get home safely,
Yep.
Within that context, imagine that the helper or the guide gets a fee for doing that. That's kind of like the active manager. Well, if the drunkard is so large, so big, they're 800-pound person.
Yep.
All of a sudden, the individual trying to guide them is actually too small to lead them home safely. And they might be pulling on them, say, hey, you need to go over here. Don't go near that highway. Don't go
Right.
near that lake. But they are too small to actually have any influence. And that's the idea that as active managers go out of business, as a result, not only does it amplify volatility in any one direction or the other, but in many ways, those active participants are not large enough to actually correct or find intrinsic value in the underlying asset.
How long ago did you undertake this exercise?
That was in 2018. I wrote a paper about that, giving credit to Mike's idea. It was called Meeting in the Waters. But I think it's pretty interesting. It does tie into this overall concept, which has been a part of my work in this Ouroboros idea, the idea of reflexivity. And it goes back to that Volatility and the Alchemy of Risk paper. And I think in that paper, I talked about this idea at the time, vol was at very close to all-time lows.
Right.
VIX was down
2017 was, we were talking about it earlier, that was peak global quantitative easing.
Yeah, exactly. And at that point, and I wrote the paper in October of that year, and I said, in the next 3 to 2 years, we will see all-time lows on the VIX and all-time highs. And that is exactly what happened. And the reason for that, passive investing is part of the story, but there's a much, much larger story to tell on this. Have you ever heard of power law distributions?
No. Edify me.
So a power law distribution is almost like a logarithmic ranking of different events, and they occur in natural systems all the time. So let me give it a perfect example. This is earthquakes. So on the Richter scale is a kind of exponential extraction, where one earthquake up the scale would be 100 or 1,000 times, a million times one lower on the scale. Another thing that follows power law distributions are wars. So an average skirmish follows neatly along this power law distribution. What gets really interesting is when things exceed power law distributions, when something breaks the power law distribution line. And this would be
you're breaking the pattern.
You're going beyond what an exponential power law would indicate.
That's like beyond infinity. Okay.
So let me give some examples on this, right? In the event of wars, most skirmishes fit the power law line. World War II greatly exceeds the power law line. When something goes beyond the power law line, it means there's excess reflexivity occurring. Other things that follow power laws, movie box office receipts. The average movie that comes out in theaters and does well or doesn't do well fits the power law. Titanic exceeds the power law distribution.
Love it.
And of course, you're followed on Twitter quite a bit. An average tweet, 300, 1,000 views, that fits the power law distribution. The tweet of someone's cat dancing that gets 50 million views worldwide.
Inevitably, yep.
That exceeds the power law line.
The British guy who was zooming in his boxer shorts who didn't realize that the camera was facing his boxer shorts.
And now 100 million people worldwide know.
Viral. So
exactly. So
I came up with an example.
So there's many, many natural systems that follow power laws. And one of the things that follow power laws are financial systems as well. You can actually plot, and this is one of the things that's relevant to my market. I'm a vol trader. Artemis is a volatility trading shop. The movement of volatility follows power law distributions. So this is where it gets really interesting.
So wait, just for 2 seconds. You're talking about as risk builds in the system, it tends to look like a Richter scale.
Yes, that's right.
It tends to behave like a Richter scale.
Yeah, and percentage changes in an asset follow these power law distributions. Okay. So classically, in this sense, we can look at like maybe the ultimate power law violation would be 1987. The Black Monday crash.
Yeah.
Well, if we go and look at volatility since the VIX started in 1990, and we look at kind of movement of implied volatility going back over 3 decades, we can plot that very nicely on a power law scale, very efficiently on a power law scale. So, of course, what becomes interesting is to see what movements in the VIX, or in this sense, the volatility or expected volatility of the market, are beyond that power law distribution. As it turns out, the stats are incredible. Almost 75% of the top power law moves that exceed what a power law line would indicate have occurred in the last 4 years.
Whoa.
Yes.
So wait, let's remind our viewers. In 2017, which was the ultimate year of complacency, the VIX closed south of 10, 54, 56 times.
So what's fascinating about this is that
so you're talking about the period that
starting in 2018 to today.
Wow. Jay Powell's whole term. Okay, keep talking. So this is exciting.
It's crazy, yeah. So that's of the top 25 ranked power law violations, almost 70% of them up and down. So everyone thinks about vol moves up. People don't think about vol moves down.
Right.
And it's close to 50% of the top 100 power law violations have occurred just in the last 4 years, with data going back 3 decades. So that is an incredible statistic to look at. So to try to understand this, because we're talking about some math concepts, let's try to put this in context of movies. This would be like Titanic, Avengers, Avatar,
Star Wars.
I
watched it 8 times in the theater.
Like Lion
I broke
King.
the law personally, all by myself.
It'd be like all of these movies coming out in the last 4 years, and like the biggest box office bombs, Heaven's Gate, Ishtar, Pluto Nash, John Mars, all coming out in the last 4 years alone.
Well, that's why. So here's a real world example. People don't understand me when I say, they're like, wow, the NASDAQ was up 450 points today. And I'm like, that's not a good thing.
Yeah, it's not a good thing.
I'm like, that's not a good thing. No.
So exactly, that's the big point, that this is like that power. I mean, imagine imagine World War II, the Chinese Civil War, the Russian Civil War, the Chinese Japanese War, all occurring in the same 4-year span. I mean, so we are seeing power law violations in asset prices, in my market at least, occur with regularity in volatility. And what's interesting about this is not just, everyone talks about VIX spikes. No one talks about the declines on the way down.
Right.
It's equally coming down. To your point, this is not a sign of a healthy market. This is not the sign of a healthy market. And there are several factors that are coming into play that were really foreshadowed in that 2017 paper. One of these can be looked at as the advent of passive investing, the dominance of passive investing. Everything that we talked about earlier is driving this, where it's a volatility amplifier. But people don't realize it's an amplifier to markets moving down and up.
Right. And we remember that, because I learned this from Vincent, that in 2006 there was a law change that required human resource departments that after they opt in a new employee, if they have not designated what they're going to invest their 401k in, then it automatically goes into a target date fund. So if you're 30 years old, you've got 70% of your investments in the stock market, 30% in the bond market, period. But that law change came in 2006. And that's when you see the magnitude of people moving into passive just go like a hockey stick.
Yes, exactly. And the rotation of these asset classes driving this, and the demographic dynamics coming into play as well.
Millennials are all coming in.
Exactly. So these are huge factors, but it's not the only factor. One of the aspects that was talked about as well is this idea of reflexivity in the vol space, the dynamic of strategies, and we talked about this, I think, in our first kind of interview, the dynamic of strategies that monetize volatility as a form of yield. And this can be done implicitly or explicitly.
Mm-hmm.
It's strategies that either are replicating a short option profile,
mm-hmm.
or strategies that are literally shorting derivatives. Well, the reason that's come about is because of when you lower the price of risk to practically zero and you can't get yield, people are now looking for ways to get yield through financial engineering. The problem now is when in a market where there's suddenly a pullback.
There's like these liquidity vacuums.
And all of a sudden you see everyone having to cover their short vol bets at the same time.
Right.
And in the other same framework, you have a situation where the liquidity in markets, and this is all an interplay to one another. The liquidity in markets is actually beginning to dry up as well, and we're seeing that even my market in VIX land. Volumes are down about 30%.
Really?
It's huge. Yeah.
So I'm going to interrupt for a minute. I remember looking back a few months ago and saying, the MOVE index is in the 30s. There is something seriously wrong here. Yeah. I mean, it was seriously lower than any historical pattern in the history of mankind after the Fed bailed out the corporate bond market.
Yes. Yeah. And so these are like people layering on risk, taking excess return, and then on top of it, also all of these strategies, and you end up having, there's a variety of different algorithmic strategies that use volatility as an input. So this becomes the snake eating its own tail, because you have the framework where it used to be volatility was a statistic to measure the game being played. Right. Now volatility is actually a player on the field impacting the game, because many of these strategies will rebalance based on the movements in asset prices and the vol.
Really?
Absolutely. I mean, you absolutely see that. The vol targeting funds have been something for a long time, and many different strategies, from risk parity to CTAs, will do this. So this is a very key driver. So it's not just one factor; it's many different factors coming into play at the same time. So, and then lastly, you have the Fed now proactively, and you've done amazing work on this, proactively responding to that volatility.
Uh-huh.
Which also explains, you have this liquidity vacuum, these massive vol spikes, and then you have equal, brutal vol moves down.
Yeah.
And this is a bit, as a guy who runs kind of a long vol tail risk fund, this becomes somewhat of a conundrum, because you have clients that are really relying on you to be there when the market is down 50%.
Yep.
If you pull off your hedges at down 10,
yep,
that's not going to meet your mandate to those people. So, but then you obviously, in doing that, you run the risk of these rapid vol collapses.
Well, I mean, of all people, Jay Powell took office in June of 2012, and in October of 2012, and Zero Hedge picked this up, of all entities. I read it first in Zero Hedge that Jay Powell commented in the transcript about the Fed and the short volatility. Yeah. And the Fed being short volatility, like personifying with QE.
With QE, yeah.
And I think the scariest thing about Jay Powell is he gets it. And he got it in 2012. And he said, one day, if we ever try to normalize, who was in the hot seat trying to do the normalization, but him 6 years later, which he had no idea would happen.
Yeah.
And it happened on his watch.
Yes. And you were so right about how they had the playbook in advance.
Oh gosh! Oh my gosh!
You
do not come up with a game plan. March the 23rd, 2020. No, that was started. They didn't. Fed staffers did not get vacation between Christmas Eve and New Year's. They had to work all through the holidays of 2018 after the markets just melted down, spurred on by credit.
Credit. That's right. The interesting thing is that a crisis was coming. I believe that a crisis was coming regardless of COVID. In many ways, COVID was the excuse, the red herring.
Lacey Hunt told in this office
That's right.
years ago, right here, Lacey Hunt said, the United States has never not gone into recession when global trade contracts for a full year. Yep. And global trade contracted for all of 2019, period. And the not QE, not working, was telling us that we were going into recession.
He said that in January, that's right. We did
here,
January,
right
February
here.
2020.
Yes.
That's right. Yeah, I remember that. And because in 2019, we were having breakdowns in interbank lending. There were breakdowns in credit. There were breakdowns in liquidity. Yep. All the signs were there. And it all comes back to this, I call it the Unholy Trinity, which is the Unholy Trinity is a triangle. On one leg of that triangle is illiquidity. On the other leg of that triangle is solvency and credit problems, and at the top of that triangle is volatility. Yeah. And it's really like you see them all come into play together. And what was happening in 2019, at that point, it was very clear that the solvency issues and the illiquidity issues were starting. So it was just a matter of time before the volatility came into play. I'm not downplaying.
And we had Steven Mnuchin then, by the way.
That's right.
Not Janet Yellen.
That's right.
So he knew. He comprehended he was a Goldman guy. He knew what was happening in the market.
He knew those workings, yeah. But there was something going on in the soul of investing, and as I sit down.
Did you say soul?
The very soul of investing is being challenged, and the very soul of capitalism.
That's deep. Okay.
Well, wait till I explain my thesis. Maybe it might be deep or not. It might be silly, but we'll see. But I think there's
We're gonna have to send you back to the cave.
Yeah, send me back to the cave. I'll go back to Sedona, and I'll try to think of something new. But this idea of, it used to be this concept that value, what drives value? And value is derived independent of the medium by the intrinsic value of an asset. So that's classic Warren Buffett, Right. It's this idea that, everything everyone learns in business school.
Yep.
You take this company.
Portfolio management 101.
Portfolio, you discount the dividends, you discount the cash flows.
The old DCF model.
DCF model, it's right there, and you look at what this company can produce and its fundamentals, and you look at, is it at or near its intrinsic value, and you make a decision.
Which, by the way, doesn't work in Japan or in Europe. They have to borrow our risk-free rate and plug it into their discounted cash flow models.
Their discounted cash flow model,
because if you plug in a negative rate, the model just kind of goes haywire.
It goes haywire, yeah. So that's the first original concept. Well, now we have a new concept. When you lower the price of risk to zero, the question that becomes now is value derived by the medium itself? So in this sense, there is no intrinsic value to an asset. It doesn't matter. All that matters is that people believe that there is intrinsic value, or they believe that there is value, and that there is a bid and ask spread created by the medium. And whether the asset produces money or not, whether it's a crypto token named after a dog, it doesn't even matter. All that matters is that enough people believe that there's value, and whatever it is, that drives the value. So the value is not intrinsically from the asset itself. It actually comes from the medium of exchange and the participation. Well, there's a word for this. It's called magic, like literally magic. So you go back.
This is where it's the not deep part. Okay.
Yeah. You go back into like Tibetan mysticism, and there's this idea of a tulpa, and in Jewish mysticism, there's this idea of a golem. And like a tulpa in this Tibetan mysticism idea is this idea that if enough people or a person truly believes something in whatever it is, then it will magically become real. Magically
manifest.
Manifest.
You've just given me a whole feather top. Thank you.
This is a magical idea, right? So, and I think most capitalists would be like, that's absurd, right? Well,
what are we witnessing?
What are we witnessing? Exactly. So, in this,
it helps that there's no antitrust in America too, by the way.
Yes. Yeah.
that helps build the magic.
Yeah. We are not witnessing capitalism. We are witnessing, for lack of a better word, mystical magic.
Yeah.
And it's this idea that whatever it is, if it's an NFT, if it's a crypto token, whatever it is, if enough people believe that there's value, then the medium will create value from that, regardless of whatever it is.
I think you can have an NFT now sell based on a thought.
And a thought. Yeah, well, that is, wow. I mean, I can't, that is literally a tulpa. So it gets into crazier ideas. Now, I'm not taking anything away from the greatness of like what Elon Musk has accomplished in his life.
Sure.
Right? I'm not. I kind of wade into some dangerous territory here. The question at the end of the day is Tesla, which has, last time I checked, maybe 1/50th the sales of every other car company combined, worth more than every other car company combined.
Right.
And, to this point, when I talk with people, it's almost like this mystical thought. Well, you can't put a value on anything he does, and it could go up 1,000 or 2,000 because, it's Elon Musk. And I'm like, that's magical. That's magical thinking.
Well, I'm going to stop on Musk for 2 seconds. So I have to share this with you. I tweeted out a few days ago because Joe Manchin said, no, we should stop and hit the reset button. We should stop and reflect back on what fiscal stimulus measures have done before we create more and just go headlong into more of the same. And so I tweeted it out and I said, I'm happy somebody's saying we should stop and ponder what we're doing with taxpayer dollars. And my Twitter feed filled up with people saying, Joe Manchin's nobody. Elon Musk, he's the leader of America.
Yeah. So this is magic. If you dare say, I'm actually even scared to even, I'm glad I got off Twitter because I would be like, I just be reloaded. Yeah.
Okay.
So, in this framework, it's actually dangerous to say these things. So I walk around, like you probably drive through rural Texas and you see like some very religious billboards out there. Right? And I respect for people's different beliefs and religion. But you drive down Lamar and you see these crypto billboards. And what's shocking about the crypto billboards is they are like, if you kind of put God in place of crypto, they would be shockingly similar. So
it's cult.
Yeah. So it's in this
beyond cult.
In this framework, I don't know what it is, but it's faith. It's faith in that sense. And so like in this idea that, there is a lack of, like, unlike classic investing where we actually are looking at counting cash flows and money.
The investing world in which investing has a soul.
It has a soul. Yeah. Now we're just going to sit back and say this has value because enough people have faith that it has value as an asset. And so that's quite interesting to me. And some of these things are pretty maybe controversial to say. I think, I might not.
Well, I mean, Chris, you're talking about empirical evidence here.
Yeah, I just kind of
You're making observations about the real world. I don't think you're saying anything controversial. You might be saying things people don't want to hear.
they don't want to hear. Yes,
That's
yeah.
different.
Yeah, and unfortunately, in this kind of world, like I think a critical discussion about these things, as we're having now, actually, when it's dealing of issues like when faith intersects with capitalism, it's kind of the experience you had on Twitter, where it evokes hate.
Oh yeah.
Because it completely shatters a belief system.
Yeah.
And that's threatening to someone's ego. So now here's the shocking thing at the end of the day. We have not been in a world of intrinsic value for the last 10 years.
Mm-mm.
And people are getting wildly wealthy
Oh,
who
yeah.
have embraced that. And there's nothing wrong with that. But
December the 14th, 2008. Zero interest rate policy, quantitative easing is launched in America.
so it is interesting, is value dead? Is intrinsic investing dead? In a world where the price of risk is kept at zero, it is worth considering whether we are seeing an evolution of capitalism into something. You always hate to say it's different this time. That's always dangerous. But are we seeing an evolution of capitalism into something that isn't really capitalism? That is something that we can't really define yet. I'll call it magic. I would obviously question that quite seriously.
Mm-hmm.
But I think, in an open mindset, it might be worth considering whether we're seeing the death.
If I tweet out about education, I'll get all these tweets back that are like, you don't need to go to school, you don't need to go to college, you can just buy Bitcoin. And I'm like, but the thing is, it's sincere.
It's sincere, yeah.
It's sincere. They believe what they're writing.
I kind of understand the crypto thing, because if you're someone who's come out and you're, $150,000 in debt, and all of a sudden Austin home prices are up 50%, you have no ability to enter that market, and you can't get a job that's going to, it actually is entirely logical to reject all of the thinking,
Conventions.
the conventions, and to put your money on a lotto ticket that enough people, like, in some ways, it's actually rational economically in that sense.
Sure.
Or, as reckless as it might be.
If you can't make the math work, then you're going to look for a plan B.
Yes, yeah. If
you're not going to drive, you're not going to have a 2-hour drive commute into downtown Austin, so that you can afford to live in San Marcos or whatever. It's not happening.
It's not happening. And
No.
if you're in a framework where it's just paycheck to paycheck, and you've got a little bit of savings, this idea, and you can't enter the housing market, you're locked out of that. It's actually somewhat rational to say, hey, I'm not going to be able to put my money in a target date fund and wait for 50 years and be able to retire off that. Why don't I take a flyer with what little money I have
Yep.
on? And in some ways, it's entirely rational.
Sure.
Rational exercise to that effect.
And it's contagious.
And it's contagious. And the more people who do well from that, and people see others doing it and doing well, it actually creates this faith-based system.
I recently, I was getting my hair done recently, and a hairdresser was like, no, I'm learning how to trade crypto on TikTok. And I went, what? What did you say? I was trying to, because my daughter does TikTok, and she does all these dances, and I'm like, they have crypto trading classes on TikTok? She's like, yeah, it's really awesome, and you can start any day. And I'm like, okay, all right, well, I'll be right there. Hold my beer.
Yeah, it is a brand new world for sure. And but the interplay of all of these things is what is driving. So we take these faith-based, like the faith in a medium, a faith in crowdsourcing belief to create value rather than intrinsic value.
Mm-hmm.
You pair that with a dominance of passive illiquidity, income disparity problems, and volatility as a reflexive driver. It is no wonder we are seeing, and a hyperactive central bank that I would argue has gone way beyond its. I know we can go down that rabbit hole.
No.
And it is no wonder why we are seeing power law distributions, including in volatility and other asset classes, occur with regularity. Including, that one of them occurred just literally 2 weeks ago over the Thanksgiving period, you know?
So let's contextualize this because, I mean, again, this is something nobody wants to talk about, but credit spreads are starting to move.
Yes.
The MOVE index has really increased. And last time we saw rate volatility pick up, it preceded late 2019's events that started to unfold in the credit markets. The difference is the Fed can't launch QE to save the markets this time. It's trying to go the opposite direction.
I think this is fascinating because something fundamentally changed over the last 3 weeks. We'll see if it sticks. But you're absolutely right about the credit spreads. You know, we go back to that. We go back to the Unholy Trinity.
Right.
And, you know, vol spikes occurring, the Reddit bets vol spike that occurred, okay, so be it. But when you're starting to see volatility go up in combination with credit spreads, OAS spreads increase, and some liquidity problems,
right.
We've seen some bond liquidity.
We've seen some deals getting pulled.
This gets interesting.
And we have to remember the Fed's bailout kept dead companies alive.
Exactly.
Now they just have more debt.
Now they have more debt. And so this gets into the conundrum that the Fed is in, you know, with 6% inflation, and inflation is on the tip of everyone's tongue. You know, I sit down with my parents are not economic people, they're doctors, but, you know, I talked to them and they were sitting back and saying, we're shopping for our grandkids this year in September, early October, because we're scared about the supply chain problems. Right. And I'm like, whoa. And then I hear, and this almost made me, you know, my mom always likes for Christmas dinner bringing us crab legs, right? Crab legs is like a holiday, like king crab, a holiday tradition.
Very Italian. We get out the shellfish at Christmas time. Very Italian.
Very Southern Italian. Yeah.
Very much. Yes.
So we share that connection.
My grandmother used to drop live blue crabs into the red sauce. She had this special vat that could hold enough red sauce that she could kill the blue crabs in it. Only Christmas time.
This sounds very, very similar.
Spooky familiar. Okay.
Well, those crab legs have more than doubled in price. So inflation's now on everyone's mind, and not just on the financial mind. It's ceased now. It is now in the mindset of America. Mm-hmm. So we have real inflation. I think anyone paying attention, we're at war with China. It's not a hot war, obviously. It is a cold war.
Right.
But
it's following the pattern, right? You go currency war, trade war, hot war.
Exactly.
That's the pattern. I mean, that's the pattern as long as mankind has been alive.
Exactly. I'm not a supply chain expert, but, you know, I would imagine that in the next, or a geopolitical expert, but I would imagine, you know, Russia invading Ukraine, but China invading Taiwan. They've already taken Hong Kong. China invading Taiwan was only going to exacerbate some of these supply chain issues, and I would not be surprised if about half the stuff in here has been made in China, mm-hmm. you know, mm-hmm. and on top of that, you know, who knows what happens.
And the Longshore Union's contract is up on June 30th.
Yes.
And they've always closed the ports.
Yeah.
Going back to 1990, every time they've renegotiated their contract, they've closed Los Angeles and Long Beach down.
Down, yeah.
So, I mean, we have, and at the same time, we have all this inflation, and this is something I've been talking about with my colleague at Quill Intelligence. All these Americans receiving child tax credits,
yes.
They're all expecting tax refunds in February.
Yeah.
They're not going to get them.
Yeah. And
there's no more stimulus coming, you know, right down the pipeline. So, I mean, the confluence of factors right now is spooky.
It's a little spooky. Yeah, it's very spooky. And so they're between a rock and a hard place. And we talked about this before, I think, in our last interview, where you know, now inflation has picked up. They have to be looking at being a little bit more hawkish. It's real. It's on the tip of people. It's not like some hypothetical. Yeah. Right, and it doesn't really seem as transitory as they seem to say it is. I don't know. I'm not an expert on inflation, so I'm not making a judgment on that. But to this point, though, the bazooka to use here is a problem. I do think they need to thread the needle, and the game plan at the end of the day is we've got a massive debt problem, massive corporate debt problem, corporate debt to GDP almost all-time highs. Mm-hmm. Right, we have huge budget deficits. But what's interesting about that is that it's not so much a problem from a corporate debt level as long as rates stay low.
Right.
That's the
refinance. Roll it over. Same commercial mortgage-backed securities. Roll it over. Just roll the paper over.
So, but all of a sudden, the main problem is that if those corporate debt yields suddenly jump up 300 basis points, you can like flat out from debt service alone, you can lop off 1/3 of corporate profits. If they jump up 500, 600 basis points, you could lop off 50% of corporate profits. They go up to the way they were in the 70s. In the 70s, the rates were very high, but there was much less corporate debt.
Right.
All of corporate profits are wiped out. But that's kind of a misnomer. And I talked to Mike Green about this in an interview we had, because in effect, the real problem is they'll go bankrupt because they can't roll the debt.
Right.
So the Fed,
it's kind of like Turkey.
It's like
the country of Turkey, because it's got a corporate debt problem. So it's being forced to do crazy things at its central bank because of Fed policy. It bleeds everywhere.
Exactly. So this ties into this whole problem because so 5% inflation a year, regardless of what they say, is probably perfect, because 5% inflation a year over 5 years, you cut your debt by 1/3. The magic of inflation. We're going to inflate, but they got to thread the needle, because 5% inflation a year with excess asset price appreciation, you solve your pension problem, you solve your corporate debt problem, and you're set to go. But if you get too low, if we go back into a deflationary shock, well, now you got pension problems. Now you got a really angry populace.
Well, again, we're talking about this stimulus coming up. We're talking about a lot of really pissed off Americans when they realize they're not getting a tax refund.
Not getting a tax refund.
And that's what they were going to use to put the down payment on the Ford F-150.
Exactly. Yeah. And then the problem then is if you overshoot we go back to levels where corporate bond yields were in the 90s, that's game over.
Yep.
At our current debt levels, it's game over. So
we're pushing. We came into the pandemic with 11 trillion. Now we're pushing 12.5.
Yep. So
high yield and leveraged loans just crossed the $3 trillion
$3 trillion mark. Yeah.
Threshold. Wow.
Threshold. Yeah. So the 70s was an example of how painful stagflation was, and I'm not predicting any of the outcome. I'm just kind of laying out different scenarios. Yeah. So the 70s is an example of this. But the problem in the 70s, we had nowhere near the level of total debt that we have now. That's the problem.
Yep.
And we had a much better demographic setup back then.
Oh gosh, yes.
So this combination of illiquidity, driven by all of the passive factors and everything else we've talked about, combined with insolvency problems, combined with the fact that they may not be able to pull the monetary policy, this is another lead up to potential volatility.
Well, that's why I'm saying they can't launch quantitative easing. They're ass deep in it, to use a really technical term. They're already in. They can't do more.
They can't do more. Yeah.
And they need. There's also this issue of, at some point the Fed's going to own too much of any given treasury or mortgage-backed security, CUSIP.
Yeah.
And that was why Bernanke had to pull back in 2013. It was a mechanistic requirement.
Mechanism, exactly.
That he pull back. And if there's no major fiscal stimulus legislation that creates a lot more paper for the Fed to monetize, your whole theory of reflexivity, how does that apply to the treasury market?
Yeah, this gets, it's actually fascinating. Lacey's probably the guy to talk to about that.
I'll ask Lacey. I'm here, so Lacey's coming. So.
I'm just a humble vol guy.
Yeah.
So Lacey's going to be the guy to answer that question. But it is interesting where you look at the 32-year, kind of bear flattener situation. Like,
we're
this is getting
and
scary.
The flattening is fast.
This is happening fast, and when that has happened at this rate, combined with that has not been a good sign.
No,
that has not been a good sign.
Again, when they were saying, I remember, buddy Jim Bianco was saying, if we go past the 90-day mark with the 2s, 10s inverted, that we're officially in recession.
Yes.
And at that moment, the Fed launched not QE, and bought uninverted, physically forcibly uninverted the yield curve because of where it was buying paper.
It's one of the most humorous things.
They can't do that.
They can't do that anymore.
They can't do that right now.
They can't do it. Yeah. People forgot that in 2019, they were doing levels of balance sheet expansion that exceeded what was happening in 2009.
Yeah.
And that's just lost in the narrative.
Well, it was just a tweaking. It was
There's
just
a tweaking.
a mechanical thing.
Yeah, and I just love hearing all the excuses when yield curves invert or come close to inverting.
Yeah.
Across my career, I've heard probably every time there's a new excuse for like why we shouldn't worry about that, and it's every single time it happens. You're about a year out to 2 years out for something really ugly.
Yeah.
So it is an intriguing situation, and what makes it really confusing is it's very difficult to kind of play it because the playbook for inflation, stagflation, and a complete deflationary shock they're two radically different playbooks.
They are.
So
And stagflation requires a functioning legislature.
That too, yeah.
And we don't have one of those.
So this goes back to kind of
Not going into midterms. That's why I'm saying
Yeah.
2022 is an extraordinary year. I mean, you're going to get tax season, the primaries, the strike on, in Long Beach, in Los Angeles.
When I'm talking about what's happening with China, and it's
all this other stuff. And trust me, Putin and Xi Jinping, they're paying attention. They know that the vulnerabilities are increasing. I hope they're not watching this interview. They'll be like, oh, volatility's on our side too. Launch, hit the launch button, hit the red button.
Yeah, it is interesting from a quant perspective in vol land. Like, it used to be like there's different ways of modeling volatility, and these different complicated quant models where you can fit vol surfaces and things like that. And everyone looks at like the expected jump in vol, but what gets really interesting is that there are other fit parameters, and one of them is the persistence of volatility. So it used to be in this environment where there's this hyper reactivity, but then the Fed has come on in that results in big vol collapses back down. And this is a stat that's fascinating. If you look at the 100-year history of, almost 100 years of the S&P, this year has represented one of the fastest rebounds from a 1% decline in the entire history of the S&P. I think you have 1995 and 1953 as the other years where there's been as fast rebounds from a 1% decline. It truly is an incredible stat.
Everything's compressed. And fundamentally speaking, the macroeconomy, we've seen cycle compression that we've never seen before.
Exactly.
We've had an entire economic cycle inside of a very shortest span of time in the history of the country.
It was a whole economic cycle in a year in 2020.
Basically.
And so, but what's interesting about this is that now we become accustomed to these fast rebounds, but the fast rebound is driven by the Fed reaction policy.
Right.
Well, the problem, and this is now baked into the way volatility is modeled.
Right.
So it used to be that volatility, like the way implied volatility was priced, it expected that when there was a vol spike, it would take a very, very long time for vol to fall back down, about 4 months. Mm-hmm. Now you don't see that. Now there's the expectation that vol will come back down.
Right.
But these are quant models that aren't really looking at common sense. Well, but I think most people have attenuated to the same buy the dip mentality. Well, inflation does change that game. To your point originally, it changes that game.
Yes.
It removes their ability to react, and it is kind of the end game problem. So it goes back
and
to
it's become political. I mean, when's the last time you heard a politician say inflation's too high, the Fed's got to tighten monetary policy? I mean, not in my lifetime.
My God, right? Yeah. So the question is, how do you position for an environment like this? And what's going to happen? I don't know what's going to happen. I never know. But it goes back to our 2020 interview in February. Last time it's just like the 100-year portfolio is something where you have different thematic asset buckets that handle everything, and you put them all together. Things like an allocation to long vol tail risk, an allocation to CT. Long vol tail risk does well in vol spikes and deflation.
Yep.
CTAs do well in periods of stagflation and inflation. You have fiat alternatives bucket like gold and commodities, and of course you have equity and bonds. And
what I learned from that interview 2 years ago was, and people always ask me, I'm like, according to Chris Cole, go bold with your gold.
Go bold with your gold.
Go bold with your gold.
Yeah.
Don't just not a little bit. Go bold.
Another Texan, Kyle Bass, has also been of that mindset.
Yeah.
So, but it's interesting because we talk about that economic cycle, and that portfolio, that 100-year portfolio, we call it the Dragon portfolio, did amazing in 2020. Mm-hmm. If you held those asset buckets, you actually made money in the first quarter, and then you made money in the first quarter, you didn't lose money, and then you caught the whole economic rebound in the rest of the year. So, in this sense, I always sit back and say, we have these interviews and we talk about these things, and there's this kind of analysis paralysis and fear. But the point at the end of the day is that there's no reason to be afraid. It's like don't fear, don't panic, just prepare. Don't fear, don't panic, don't predict. You don't need to predict.
Right.
Just prepare.
Right.
And if you hold enough asset classes thematically diversified based on not assets, because assets don't matter.
Right.
You diversify based on market regimes.
Potential outcomes.
You're going to be fine
Right.
through whatever happens. We have back in 2012, I did a paper where we had it's still my favorite graphic, that was illustration. And it was a bunch of ships representing different countries. And it's right out there in the lobby. But it's also on the paper, Volatility at World's End. It's a bunch of ships which represent each country. There's America tied to China, tied to all the European countries, and the EU. And that that collection of ships is traveling through this narrow strait. On one end of the strait is this waterfall, this horrific waterfall of deflation. Mm-hmm. And on the other end of the strait is the hellfire of inflation. Mm-hmm. And so the goal of policymakers, obviously, is to gradually sail these ships through that extreme. Now, what has happened is that as they have done radical policy after radical policy, that strait between the hellfire has gotten more narrow and more narrow and more narrow, and it is more narrow than it's ever been. And one policy misstep, or it could just be a geopolitical misstep, is enough to tilt us in one direction or the other.
As I like to say, we don't need a black swan. We don't need a pandemic. We need a gray swan.
Exactly.
So your swan doesn't even have to be black, which is just bizarre. So we're going to have to continue this discussion.
Yeah.
But I have a final kind of existential question to wrap up with.
Sure.
Now, I know your grandmother's preference was Godfather 2.
Yeah.
Robert De Niro was young and hot, so is mine. So what's your favorite, Godfather 1 or Godfather 2?
I like Godfather 2.
You like Godfather 2 as well?
I like Godfather 2 as well.
So between your grandmother, you and me, we have consensus.
Yeah, but I think you and I are in agreement on this. They're really one movie. So
they are one movie.
Yeah, they're one
movie. Godfather 1 does not. One was not. I mean, you can't have one without the other.
Yeah, and we were talking about this earlier. How my grandmother, who has passed away, but looking down on this, we bought her a VCR back when VCRs were a thing.
Yeah. And
she had, just 2 tapes. It was like Godfather 2. And that was the entire reason for the VCR.
There's that other one that she didn't have, which we don't have to talk about.
Yeah,
like the Voldemort of Mario Puzo.
Yeah, we'll just pretend that one doesn't
exist.
She didn't have that one. She only had one.
I bet she didn't.
So yeah, but I know that we both have the Italian.
Oh yeah, now I know that if I went to your house at Christmas, or if you came to my house at Christmas, it would smell the same.
It would smell the same.
It would smell like really good shellfish. So and we're around the holiday season, so thank you once again so much for hosting Down the Middle, for letting us film in this beautiful space, for providing sunshine. That was a bonus, so thank you. And let's do this again in a few months.
Absolutely.
I think we need to do a compressed interview schedule, because I think the first and second quarters of 2022 could be very bumpy.
Well, it's always a pleasure. I came out of my cave. Sean's like, we've got to, it's Danielle. We got to work with Danielle. I'm like, oh my, of course it's Danielle.
Oh.
It's like I'm not going to do it for anyone.
Oh, flatter me more. Okay.
Because you're actually you get it.
Thank you.
So I really do appreciate this, and it's our pleasure to host you here. So.
Well, thanks for having us again, and I'll see you again soon.
Absolutely. Yeah. Wonderful.